Good morning. This is Dr. Mayer, and this is our lecture related to Chapter 14, Accounts Payable. Now, you may remember the discussions that we had related to purchasing and inventory. We had talked about accounts payable being the final part of the cycle. So some of the stuff that we're going to be talking about today relates to the complete cycle of purchasing, receiving, and accounts payable. So let's start our discussion related to accounts payable, related to what are the objectives of the auditor. The initial objective of the auditor is to assess the risk of material misstatement. We are going to be considering the inherent risk, including fraud risk related to accounts payable, and then we need to understand the control risk by understanding the controls over the accounts payable process. Once we've assessed the risk of material misstatement, we're going to design test of controls and substantive testing that substantiate the existence, the management assertion of existence, that the accounts payable exists and the client has the obligation to pay these liabilities. We need to establish the completeness of the recorded accounts payable, verify cutoff, establish proper valuation and accuracy, and then finally determine the presentation and disclosure of the accounts payable. Our primary concern related to liabilities is the understatement. So what we're primarily focusing on from a management assertion perspective is the completeness. Understating liabilities exaggerates the financial strength of a company. In addition, given that liabilities relate directly to expenses, an understatement of liabilities may be tied to an understatement of expenses and thus an overstatement of net income. The control process of accounts payable should start with the purchasing cycle. Remember that we talked about this concept of a three-way match. Purchasing is responsible for ordering goods, for maintaining the contracts with vendors, for maintaining pricing, and establishing the amount that is actually ordered. The receiving department is going to receive these goods into the system. Once the items have been received, they create a liability. Then, as part of the three-way match, accounts payable is going to match the invoice coming from the vendor to what was received and what was ordered by the purchasing department. If the match is correct, where all items are correct, we ordered it, we ordered the quantity, we received the quantity, the pricing is appropriate, then what accounts payable should do is they should approve for payment. The payment then is made by the Treasury Department or by the Accounting Department, and once it's been paid, the payable should be canceled to prevent the duplicate payment of an invoice. Let's talk about potential misstatement in accounts payable, whether due to error or fraud. You notice the first item relates to fraud. A bookkeeper or someone in accounts payable prepares a check to himself and records it as having been issued to a major supplier. So the fraud basically works like this, is we have a three-way match. The match is for a legitimate purchase order. What takes place is then the accounts payable clerk will then change the payee to himself or to his friend. The controls that we would be looking for to prevent this type of fraud would be primarily related to the control of the vendor file. We had talked about before that the purchasing department is responsible for the vendor file. Changes, additions to vendor information can only be done by purchasing. Accounts payable should not be able to actually change the name in the payee. In addition, we want to make sure that payments are only made to authorized vendors. If payments are made only to authorized vendors, there are specific controls in place over the vendor file, and we're only approving for payment those items that have a three-way match. A corresponding fraud that may take place is not necessarily internal, but it relates to the internal control structure. Many fraudsters will send legitimate-looking invoices randomly to accounts payables. If the accounts payable does not have controls whereby they're looking for this three-way match, they may inadvertently pay for an invoice that is totally fraudulent. A common error that we see relates to duplicate payment. Many times, vendors will send multiple invoices to the accounts payable department. They're doing this because they want to get paid. However, the concern is that inadvertently, accounts payable will make a second or even a third payment to these multiple invoices. To prevent this, what needs to take place is that when the payment is made, the accounting department will cancel the invoice within the system to prevent additional payments. Once we've assessed the risk of material misstatement, we need to determine the nature, timing, and extent of further audit testing, whether it is test of controls or our substantive testing. In terms of test of controls, what we want to do is we want to verify a sample of postings to the accounts payable control account, vouch to supporting documents a sample of postings to selected amounts in the accounts payable subsidiary ledger, test IT application controls. And this means primarily looking at access controls related to the vendor file, changes to the vendor file, and if this is an ERP system, identify who has made that change and when they've made this change. If necessary, then we would revise the risk of material misstatement based upon our test of controls. Specific testing that we will be doing related to substantive testing, and again, substantive testing, we are measuring monetary misstatement, is obtain the trial balance and reconcile the balance to the general ledger, vouch the balance of payables to selected creditors by inspecting supporting documents, reconcile liabilities with monthly statements from creditors, confirm accounts payable, perform analytical procedures for accounts payable as well as related accounts, search for unrecorded liabilities, including accounts payable, perform procedures to identify accounts payable for related parties, and then evaluate the balance sheet presentation and disclosure. We should be alert during the reconciliation and confirmation process for unrecorded liabilities. We need to examine transactions that are recorded following the year end, compare cash payments after year end to the accounts payable trial balance, examine cash disbursements over a specific dollar amount during the subsequent period. We had mentioned that the accounting system creates a liability when the receiving department receives the goods into the system. The auditor should examine this receiving report to identify any unmatched items. These unmatched items may reflect items that represent liabilities to the organization. The next item relates to vouchers payable. Many times an organization will bypass the purchasing department for things such as consulting and other activities. When this takes place, the department will create a voucher payable based upon the invoice coming from the consultant and then send this to the accounts payable department. These items may not be submitted to accounts payable in time. They reflect a liability to the organization that's unrecorded. Let's talk about additional potential unrecorded liability. During the course of the payroll cycle, the payroll department withholds specific amounts from the paychecks of employees. 401k contributions, insurance, federal and state and local income taxes, all these are withheld from the paycheck and, generally speaking, submitted for payment immediately after the payroll cycle. However, there may be a timing issue whereby as of the balance sheet date, some of these items may not have been submitted for payment. Therefore, we need to determine if in fact there are amounts that have been withheld from the payroll cycle that are liability. Let's also talk about the liabilities associated with customer deposits. In many industries, such as real estate, we are accepting customer deposits on leases. These deposits are not ours. They're going to be in our bank account. They're going to show up as cash. There should be a line item on our financial statement that represents deposits received from customers. However, the corresponding liability is that these become payables, and these are payables back to the customer. So with our customer deposits, there should be zero net impact to the financial statement. Okay, we covered the primary issues that I wanted to cover in this lecture. I thank you very much for your time, and I'm looking forward to our next discussion.